Day 17 of degraded Hormuz transit capacity. Prediction markets are currently pricing normalized commercial flow, resuming by day 45 at 60% probability, while forward freight agreements already discount permanent alternative routing. The disconnect between physical reopening and commercial normalization is where risk concentrates. Today, we examine the reopening timeline, the claims backlog mathematics, and the specific political conditions that would shift that probability to 90%. The maritime insurance constraint remains the primary friction point. Even after any pause in hostilities, the Lloyd's Joint War Committee maintains its listed area designation until independent risk assessments confirm sustained stability. These designations do not lift automatically. Underwriters require verifiable data on mine clearance, navigational safety, and absence of residual threats, processes that historically extend 30 to 60 days beyond the ceasefire. The economic translation is immediate. Additional war risk premiums average $100,000 per vessel per day for VLCCs on the standard London market wording. At that loading, a 30-day round voyage shifts from marginal profitability to outright loss for many operators. This functions as a secondary closure. Physical passage may resume, yet commercial viability does not. The claims backlog compounds the issue. Insurers are still processing exposures from the initial restriction period. Until reserves are adjusted and reinsurance treaties renewed, underwriters apply blanket surcharges. Forward curves already embed this lag, pricing insurance normalization 3 to 4 weeks after any physical milestone. Historical precedent data sharpens the forecast. During the 1984 to 1988 tanker war, each major escalation phase produced operational disruption periods averaging 21 to 28 days before commercial volumes recovered to pre-incident baselines. These were not blanket closures but effective capacity reductions driven by insurance thresholds and convoy scheduling. In 2019, following discrete vessel incidents, risk premiums spiked but normalized commercial transits resumed within 7 to 10 days once naval escorts were confirmed and the Joint War Committee issued interim guidance. The 2021 Ever Given Suez blockage provides the closest logistics-only comparator. 6 days of physical obstruction generated a 4 to 6 week global schedule recovery as vessels rerouted and ports cleared queues. Conflict scenarios extend this timeline by the insurance mathematics already described. The pattern is consistent across decades. Physical access returns faster than economic access. Risk assessment models therefore weight the insurance layer at approximately 55% of total reopening friction, with historical normalization curves showing a median 38-day window from de-escalation signal to full commercial throughput. The reopening triggers that prediction markets are aggregating center on 3 verifiable milestones rather than ceasefire language alone. First, diplomatic normalization indicators such as embassy reopenings and ambassadorial returns, which signal durable political commitment beyond tactical pauses. Second, naval de-escalation patterns, observable withdrawal of capital warships from exclusion zones, confirmed through open-source AIS data and satellite imagery. Third, the operational verification lag once the first commercial vessel completes a full transit under standard hull and machinery terms. Markets assign only marginal probability uplift to ceasefire announcements. The probability curve steepens materially only when all 3 conditions align. The lag between physical passage and insurance clearance typically spans 48 to 72 hours, while classification societies and P&I clubs issue updated advisories. For real-time monitoring of these exact contract resolution dates and Joint War Committee listed area updates, the Maritime Risk Forecasting Infrastructure at t.me/future_tradebot aggregates the relevant probability surfaces and regulatory notices as they evolve. The supply chain domino effect extends far beyond the strait itself. Prolonged restriction has driven floating storage utilization toward saturation levels, with approximately 25 million barrels currently held at sea in the Arabian Gulf and Indian Ocean. This inventory buffer buys time, but erodes as storage costs compound at current VLCC charter rates. Alternative routing via the Cape of Good Hope adds 10 to 14 days per round voyage and consumes an extra 8 to 10% of global tanker fleet capacity on a sustained basis. While the industry has demonstrated resilience through these diversions, evidenced by 2019 and 2021 rerouting exercises, fleet utilization efficiency drops, elevating spot freight rates, and tightening product availability windows downstream. Reopening the strait does not trigger immediate price normalization. Queued vessels must sequence through the narrow channel under heightened scrutiny. Insurance policies require individual voyage approvals, and long-term charter contracts already shifted to Cape routing must be renegotiated. Full supply chain equilibration therefore trails physical reopening by an additional 25 to 40 days in baseline scenarios. Summarizing the reopening probability curve, maritime risk forecasting platforms currently assign 60% likelihood to normalize commercial flow by day 45, rising to 85% by day 75 once insurance and diplomatic triggers converge. The tail risk beyond 90 days centers on prolonged listed area status rather than renewed physical interruption. For institutional operators and supply chain planners requiring continuous visibility into these dynamics, the maritime risk forecasting infrastructure at t.me/future_.